Let me try to pull something up. Y'all
Talk amongst ourselves.
can you like burn 30 seconds for me?
Yeah. Bought any eggs lately?
No.
All thoughts and opinions shared in this recording belong to the participants. This podcast is meant to inform and educate and should not be seen as solicitation or endorsement for business.
Welcome to the Market Moment. This is Matt Walters, and I'm with Lee Mackey
Good morning.
and John Marfeld.
Good morning.
And got a couple interesting topics today. Going to talk about what the market's done year to date, kind of the major indexes. We're going to talk about change, the penny, dollars and cents, and then we're going to talk about states and different things to consider when you're thinking about retiring, where you should retire to, and just, I don't know, how big of a difference it can make depending on where you retire, and the state, local tax situation.
Yeah.
So
Yes.
anything before we jump into it? Y'all are always
Football season's
Yep.
officially.
Football's over.
officially over. Chiefs
Yeah.
got smacked.
Chiefs
Yeah.
got smacked.
It was just a lackluster, from the game to the commercials to the halftime show. I mean, it was not one of those where you're coming back the next morning
Yeah.
saying, "Oh my gosh, did you see these
Yeah.
3 or 4 commercials?" And
Yep.
the game was over by midway through the second quarter. Just a kind of a dud, especially if you paid $5,000 or $6,000 for a ticket and you're a Chiefs fan.
The best
no
part was
doubt.
when Trump got cheered. Everybody was super excited, and then they booed Taylor Swift. I love that.
I know that was pretty.
Not that I don't have
interesting.
anything against Taylor Swift either. I just thought it was funny because
It is funny.
the whole Kelsey Swift thing is just kind of okay.
Well, she's from Philadelphia, so her family's an Eagles fan. She
Sure.
grew up an Eagles fan, and then she's wearing Chiefs jersey. So you know that the Eagles fan were going to give her all kinds
the
of
love
trouble.
of her life plays for him.
Right, the love of her life.
Yeah. All right. So the markets, what have they done year to date? So when we're looking at, the last few years, right, we've got the NASDAQ just kind of dominating, right? Large cap tech has really led the way for a long time now. But year to date, it's got a little bit different story. So we've got the Dow Jones Industrial Average.
That antiquated
Yeah.
30.
I feel like I'm talking about
stock.
the Great Depression era.
Lee and I grew up with the Dow, so we're not that far back.
Yeah.
I mean, I remember so vividly the news, like the 5 o'clock news or
Yeah.
6 o'clock news, as they would go into a commercial from one of the segments, the first thing they would say is, and the Dow Jones Industrial Average was up, 14 points. And that was when the Dow was at 1,000.
Yeah.
Well, and a big part of the reason the Dow became less and less relevant is one, back in the 90s, there were so many more publicly traded companies, right? And so the Dow's 30,
Yeah.
right? And so it just wasn't as good of a representation of the market as what it was years and years and years ago. And two, it's price weighted.
Sure.
So there was, the argument of well, it's not really a good indicator of the major players in the market, like a cap weighted index might be.
Right.
But still extremely valid, extremely relevant.
We still use it.
Very important. We still use
Yep.
it. Some more than others, but yeah, it's still a very important index. But the Dow is up. Total return. Gosh, I'm getting old. I can't even see that. Let me zoom in. I need large print.
4.2% year to date.
4.64 total return.
Yesterday.
This was as it closed yesterday, with the NASDAQ up 3.5, the S&P up 3.2, and the Russell up 2.66.
Yeah. So
you've got the Dow that it's kind of leading the way by a solid % or more over the first 5 weeks of the year.
and it we've talked about this before, but the market has broadened out.
Well, it started that last fall, early in the
yes.
fall, and then it
Yeah.
kind of stopped, and then you saw tech kind of rally again. You're like, crap, here we
Here
go
again. Yeah.
Here we go again. But we started the year where it's okay, we've got broad participation.
The Russell 2000, makes up a lot of stocks, and to see it broaden out, and most people feel like that's a sign of a healthier market when
Right.
not just 7 companies are leading the S&P or the NASDAQ.
Well, a week ago, the Russell was outperforming the NASDAQ
Yeah.
and the S&P 500 year to date.
And if you
The
go
last
back,
week it's
if you go back a year, so we're going back to early February of 24. Most of the indices are in the low to mid 20% range. So I mean, again, to evidence that broadening out of the overall market.
Best part about that news is that they're all positive. year to date.
Sure.
I mean, that's the nice thing, that we continue to have this market run. Although I do think that when you're at these levels, it's kind of like you're at the top line of level. So any bad news can waver that a little bit,
Sure.
right? And we've seen that when we had the little Chinese tech stock scare and we had some other stuff. The market can react pretty high when you're at these levels.
The market's bouncing around the last few days with the whole tariff situation, right?
Yeah, the tariffs are scaring people.
That's making the market very jittery. And just to your point, when the market is already at or near all-time highs, any kind of news flow is going to, make a bigger difference.
What I find interesting is most of us up here felt like this year would be a good year, maybe not a great year. Most of the analysts that put in their projections, kind of showed a year-end target of around 6,600 or so. But I mean, we talk to clients a lot of times and say, we'd love to average in the 7 to 9% range, good moderate blend portfolio. We've almost got half of that.
I know.
In the first 5 weeks of the year. And, as we've been doing reviews over the last several weeks, it's kind of surprised. I mean, it's snuck up on us a little bit.
Yeah, but my recommendation to everybody is we have gotten used to these returns, and they're not normal. If you look at the S&P 500 since the inception of the S&P 500, it's averaged about 11% a year, right? So when we have these years that we just blow through that, we're doing well, there's going to be somewhere where that gets back to normal, and it's going to be from less than 11%, if that makes sense. So it's not that this train is going to keep going full speed forever. It can't. So that's my biggest concern, is that we continue. I love the fact that the market continues to move forward. That's great. And we're trying to get our clients this, like you said, 7 to 9 being in a moderate portfolio mix, which I think we still can. But the expectations are getting just out of control.
Two things. One thing I find interesting, and then another piece of information: foreign stocks, which have lagged for so long. Foreign stocks year to date are up 5.5%, almost 6% year to date. Going back 1 year, they're up about 11%. So we've got half of international stocks in the last 5 weeks. They also, to an interesting point, and one reason I think the stock market has begun to shift, back up a little bit, is the 10-year. The 10-year hit 4.9 2 or 3 weeks ago, and now we're hovering in between 4.4 and 4.5. People be like, well, what? That doesn't make a real big deal. Yeah, it does.
Oh, it makes a huge difference.
I mean, and so having that 10-year bond fall to 4 or 5 or just slightly below, money is going to naturally go to risk on.
Yeah.
Versus, I mean, I can go get almost a 5%, riskless rate with the Treasury.
Right.
So that I think more than anything else has probably aided the
I
equity
agree.
markets.
I agree. Yeah.
No, go for it.
Well, no, I was going to say one last thing. When you talk about the international markets, if you go back 100 years, back to the Great Depression through now, small cap stocks are the leading returning sector by a long shot. And then it's international stocks. And then down below that is large cap stocks, U.S. large cap stocks. However, that goes back 100 years. We know the market's different today than it was the first 50 years of that 100 years. But the resurgence of international and small cap is no surprise. It will cycle back, and I think small cap, we've been talking about that for about a year. Is it going to start cycling back?
And this is it absolutely will. But things take time.
Yeah,
right. Sure. I know 3, 6, 9, 12 months can feel like an eternity when it comes to the markets and waiting, but some of these trends and cycles can be years. And have been years.
Oh, yeah.
But it doesn't mean that it's going to be forever or it's not going to be forever. So
right.
Talking about this year being kind of maybe just a modest year, right? It's interesting. When you go back to 2000, the market has been up every year except for 8. Okay. I say the market, the S&P 500 for you Dow Jones.
Yeah.
So the market has been up every single year except for 8. Of the years that it's been positive, only 4 have been by less than double digits.
Right.
So most of the time, it doesn't mean we can't have a 9% year. We've had,
Sure.
we had a 3.5% year in 2007. 2016 we were up 9.5. So there's some years where it's the market's just slightly up, but most of the time the market's up.
When it's up, it's up
15-20% or more. And then when it's down, we've got a couple. We've got obviously the .com bubble, the great financial crisis, and then we've got a couple.
Like 2022.
2018 was down 6%, so it wasn't a complete
right.
sell off, but it was a tough year. And then 2022 is down almost 20. So, you know, the market tends to move. You get to the 11%, 10-11% averages, not because you get kind of consistently 10 or 11%.
It's not a smooth,
You get there because you get 20, 25, 30 minus 10. 15, 20 minus 3. Right?
Just the only thing I cautioned, I had one client call me. He's a builder and he's doing real well in life and so on. He wants to retire and he says to me, he goes, "Hey, I'm going to give you a bunch of money and I need to make 12% a year off of it." And I'm like, okay, we're going to have to take massive risk to get that. I mean, you're going to have that fully in the market. Well, I don't want to take risk. And I think that he goes, but the market's been doing so well. I mean, we've done so well. Like that's the point.
No, it's so we get used to. I mean, I've heard, you know, over the last few years, I've heard, well, can we not just buy the S&P 500 so that it's safe? So we keep it safe, you know. And it's just that it's just because we've just seen it go up for long now.
People forget 08, that time frame was down 54% from the end of 07 to the beginning of 09. 54% the S&P.
2022 is down 20%.
I know.
You know? So,
it wasn't that long ago. I know. The same thing on the interest rates. I have a lot of clients coming in and say, well, I'm just going to wait to buy my house till the interest rates get back down to 3. Mm-hmm. And I'm like,
okay, enjoy that apartment.
I know. I don't think it's, I mean, it may get down to 3, but I can't. It's like we got used to things and then you don't realize that it's out of whack and it's an anomaly and things will get back, you know, we'll pull back. But anyway.
Let me try to pull something up. Y'all
talk amongst ourselves.
Can you like burn 30 seconds for me?
Yeah. Bought any eggs lately?
No, I got Kathy a dozen for Valentine's Day.
That was actually funny.
Yeah.
Oh
I'm gonna paint them, and you know, she deserves that. That's a big heavy price present.
Blakeman's Walmart neighborhood market, a dozen eggs. I mean, oh my gosh.
Okay, so what I was going to
we're done with the egg conversation.
That I was, for the audience sake, I was trying to hurry as quick as possible.
Back to our regular scheduled programming.
No, so we use a system called nitrogen, right? And it helps us manage and look at how much risk is in a client's portfolio, how much volatility based on kind of the standard deviation, 2 standard deviation moves and all that should you expect if you're invested in this way. And what's interesting, you know, you look at, and this is just nitrogen. I'm not saying this is truth or this is factual, but, you know, nitrogen in their system, they have a targeted annual return if someone invested in a moderate portfolio is 6.2%. Yeah. Like that is their long-term historical, that should be kind of within your acceptable range of returns.
Yep. And that's 40% bond,
that's
60%
like
equity.
60-40 portfolio. Yeah.
Typically.
Moderate conservative is 4.4.
Wow.
Right? Moderate aggressive, 7.8.
Wow.
Right? So I think there is a reality of like when you, and this is just a third party.
They're taking years and years and years of history, right? To come
so
up
if you're
with
invested in a moderate aggressive portfolio, like you're taking some risk, you probably have 70 to 80, 85% allocated to equities, right? Where you're taking full market risk. A 7.5 to 8.5% return is kind of where you should be in terms of your expectations. And that is absolutely, over the last 5 to 10 years, that has been stretched because that's what we've seen.
Right. Expectations have been stretched. When we do our retirement planning, you know, when we do the we come to the end of it and it shows us, I always leave the investment return at 0%, and I put on all the data, their income, their assets, their expenses.
Yeah, like
and
here's what it would be if
we made nothing. Yeah. And typically it'll show us a percent it needs to make for them to make it through retirement.
Yeah.
And you want it to be 5, you know, want it to be as low as possible, right? Sure. So typically, I mean, most of the time, our clients are pretty savvy and they're doing the right things. It usually falls between 5 and 6%. It really does most of the time. And clients don't understand that's pretty impressive, insightful numbers, because that would mean they need to be moderate. Right. We've been taught that that's really conservative, ultra conservative, because the market's done so well, and they think they're going to make 20% if you're aggressive. But I love that. I love you. That's a great point, Matt.
Yeah. Thank y'all for buying me 30 seconds.
You bet.
I apologize to the audience.
Hey, the egg thing was pretty important.
The egg thing, that was funny. Okay, so coins. So change coins. I don't know even how to reference. I don't think I own a penny.
Having no sense is
apparently Trump
is common sense.
Oh boy. Apparently Trump is getting rid of the penny, which I think makes a lot
Makes
of
common sense.
I don't want to say that word
Stop,
again.
stop.
So, but apparently a penny. So this was kind of news to me because I don't randomly look up facts about pennies. But it costs 2 or 3 cents to make a penny, and people lose like billions of pennies a year or something crazy. I mean, they like lost in couch cushions and go down drains and so it's kind of like when this came out, I was like, why do we have pennies? I've never thought about it before, but I don't know. I think it makes a lot of
In the 90s, Seinfeld.
With all due respect to Abraham Lincoln.
Yeah. In the 90s, Seinfeld ran an episode where George had to get calzone for George Steinbrenner of the Yankees.
Yeah.
And Kramer, if you know Seinfeld, this is funny, but he had to go get these calzones, and he tried to pay with pennies. And the calzone owner, the pizza owner, kicked him out because I'm not taking these pennies. And that's 30 years ago, right? That was funny.
Yeah.
They didn't want to take pennies. I mean, pennies have been obsolete for a long time.
Right.
And if they cost more than they make, it makes a lot of
sense.
To get rid of the pennies.
I think
114 billion pennies are in circulation. $1.14 billion.
Wow.
In copper pennies that if you saw one on the street, you wouldn't stop to pick
Hey,
it up.
so if you don't want your pennies, just ship them all to me. I'll take them off your hands. If we get enough of them, it's going to make a difference.
We'll be back there rolling pennies.
And I think there's always been this undercurrent of, how much longer do we have, currencies? I mean,
right.
Including cash to some extent.
We need to do penny. Sorry, this was
right.
such a good idea. I had to get it out.
Yeah, right. You're in the middle seat.
We need to do penny drop boxes around town, so people can just drop.
Just
off
get
their
rid of their
change
old pennies.
and just-
It's a good idea.
Revenue source. Perfect.
all goes to charity, of course.
That's a good idea.
But it is interesting. I mean, I think that, I did hear this morning though that Congress governs the currency issue, and so I don't know if an executive order can
actually do it.
Can stop.
But
I don't think that's stopping Trump
No.
on it.
No, it hasn't. I mean,
not yet.
Courts will have to stop anything. But it's funny because it makes total sense. Like I would think if you polled Americans, again, overwhelmingly they would vote for term limits and getting rid of the penny.
Yeah.
Those two things I know would be overwhelming.
Most pennies people have are in some giant jar in their house somewhere,
And they
that
can't
they've
get
been
rid of it.
collecting.
But
for
it'll
30
just be
years.
weird when we have to say a nickel for your thoughts. Sorry. Okay. Okay. Just make that up.
But how far do they go? This is the question. Is like, well, when does it make sense? I mean, how much does it cost to make a nickel? I bet it's more than 5 cents.
You're 100% right. It's eventually.
So you get
in Canada eliminated the penny in 2013, and they rounded all transactions, not individual items.
Yeah.
But they rounded all transactions up to the nearest 5 cents.
Which makes total sense. I mean, again, not even trying to, sound. Anyway, we got to move on.
Yeah. So
No, that's very interesting.
hashtag FedCoin. Is that what we're saying here?
It is. Maybe. I don't know.
And then the last topic, the flow today is just really
where to retire.
yeah.
Oh yeah, where to retire?
If you're pinching your
Pennies, your nickels.
That was awesome.
If you're pinching your nickels.
Yeah. Oh man, the sarcasm when setting between, Lee and John.
I just made myself laugh. That's
You're crying.
Oh my gosh.
Okay, so things to consider when you're thinking about retiring and where to retire. We didn't full disclosure, we didn't do any research. This was just something we were talking about.
Yeah.
And we see it with clients. We have clients that move to Florida or, move from Minnesota and Michigan down to Arkansas because they're trying to get in a little bit warmer climates.
Yep.
And so we see a lot of clients and work with a lot of clients that are, moving around those retirement years for various reasons. And so just thought it'd be kind of good to quickly touch on things that we see that you should consider or think about, financially that can make a huge difference. I was looking at someone's situation the other day. They live in Illinois. They're going to move to Florida. They've already bought a home in Florida. Yeah. And when we were doing the retirement analysis, I had everything built out. And the only thing I changed was their home state, Illinois to Florida, right? And it drastically improved the long-term projections because of just the state tax situation and some of the assumptions there. So it can have a big financial
yeah.
impact
Yeah.
for sure. So what are some things that you think of when we're looking at when someone's thinking about moving or retiring?
Some of the obvious state income tax. That's
Yep.
one. The cost of energy, gas,
Property taxes.
property taxes. I mean, they all typically revolve around taxes. I think healthcare to a lesser degree.
Most states are good with healthcare. To your point,
Climate.
Climate is important. Kathy and I made a big move a couple years ago. We moved to Arizona for 4 months. We moved out there during COVID, and we moved out on June 1st. So if you're going to move to Arizona, do not pick June 1st as your start date, because you will hate your life for the 4 or 5 months that first 4 or 5 months, because it's like 130. I mean, we were cooking our eggs on the car top. It was so hot, I can't even tell you. But one of the biggest concerns about like Arizona is our water bill was $900 a month. Our electric bill was about $800 a month. We had to leave our air conditioning on. We had the first bill, and we were like, oh my God, what's going on? And we asked neighbors and so on, and they're like, oh, you got to keep your air conditioners at 80 degrees during the summer. So things like that you don't think about when you move to different climates, hot, or just what is the water like in Arizona? They have a water shortage issue,
Sure.
So their water is more expensive. So $1,700 for water and electric is a house payment.
Yeah.
Right. So that's a huge thing. You should look at all of that stuff when you move. State taxes free, like Texas, Florida, Tennessee, Nevada. There's a couple others.
I think every state
South
that
Dakota,
that borders Arkansas
does
does not have a state income tax.
Yeah. Well,
No, that's not true. Oklahoma
does.
Missouri does. Yeah.
Do they really?
I think so. Yeah. Yeah.
Okay,
Yeah.
well,
Louisiana
then
does.
scratch that.
There's about 7 states that do not have state income tax, but you have to
Tennessee
check.
and Texas don't. Okay.
Like I said
You
at
have
the
to-
beginning of this conversation, we didn't do any research.
No, but you have to. Those states, it's not as simple as it's going to be a lot cheaper. Like from Illinois to
hilarious.
Illinois is a nightmare, right? My in-laws live in Illinois. I know that. But a lot of states, you move to these places for state tax free, and you think you're going to be living there cheaper, but you have to look at the property taxes.
So let me touch on that.
everything
So
else.
property taxes. So because you're exactly right. Some of those states with no state income tax, gosh, have higher property tax. They have to get the revenue from somewhere. So you have to be aware of that. But there are states that freeze property taxes or freeze assessment values after a certain age for seniors. Arkansas being one of them, right? After 65. The income limit is less than 400% of the supplemental security benefit in Arkansas. But for other states like Illinois, actually, I didn't know this, but Illinois has an assessment freeze for 65 and older, but it's only on people that have less than $55,000 of income, right? So
Right,
you have to know these things. But there are other
Yeah.
states. Arizona has no income limit, and they freeze assessments after age 65. So, it's not going to make it less expensive year one, but it is going to, control
Over
the
time.
ever increasing
Yep.
expense related to property taxes. And so that's definitely a big one. Like Lee said, a lot of it has to do with property taxes, state taxes. Some of it has to do with just basic utilities and other things that you need to be aware of. Insurance costs, right? Florida's a great state to live, great place to live,
yeah.
but insurance has gotten a lot more expensive, and I think will continue to do so. And
yeah.
just trying to insure your home, depending on where you live in the state. There's things that you have to take into consideration. It's not as easy as, hey, we can afford to buy a home there, so we can make it work. Maybe you can. You got to look at all the details.
Well, Lee was pulling up something earlier, and Florida was in the top 5 most expensive states to
Yeah.
retire to, and I don't
Yeah.
think anybody would guess. I would never have guessed that. Why
And
was
you
it
know
state
what?
tax free.
In 24, we're 2 of the cheapest: Illinois and Pennsylvania.
Really?
And I wonder if it has to do with some of the
Like
freezing of
other-
the
The
assess-
freezing
yeah,
over
yeah.
65. Yeah.
But I
yeah.
thought
I would never have guessed that.
And I wonder when that,
Anyway,
it's
and-
probably very different for people at different income levels.
Right.
Yeah, I
right,
bet
right,
so.
In
right.
some of those states, it's probably different for.
And y'all are correct. There are currently 8 states that
8
have
states that have
no
tax
income
free.
tax. So I will officially
Yeah,
tender my
but
resignation from the podcast.
But all 4 or 5 that border Arkansas are part of that.
Actually, not 2.
So, anyways, you're just trying to put out a challenge to
Yes.
Sarah Huckabee to.
That's right.
get us
Yeah,
there.
she was
More
supposed to help us make our
We need her
taxes
to.
come down.
We
our
need
state
her to
tax.
think that all the border states are state tax free.
Yes, I'm sure when she turns on our podcast this afternoon, she will
Yes.
take that under advisement.
Yeah. All right. Well, we better stop before we get ourselves in trouble.
Hey, I
But-
want to shout out to Lee's mom. I'm glad I'm your favorite, and I had a long time to think about that, and I'm very appreciative of that.
Johnny will be very happy.
Yeah. No, we have fun on here. We get feedback from you guys that listen, and we really appreciate it. We have this is kind of a fun outlet for us, just because it's something a little different than our day to day. So we appreciate you guys listening. Give us a like, subscribe, share it on social media. We always appreciate it, and we'll see you guys next week.
Have a great week.
Have a great week.
The hosts of the Market Moment podcast are employees of Mach 1 Financial Group, LLC. Mach 1 is a registered investment advisor located in Rogers, Arkansas. Mach 1 may only transact business in those states in which the firm maintains a notice filing or has qualified for an exemption or exclusion from registration. A copy of Mach 1's current written disclosure brochure is available through the SEC website and available at disclosures.mach1fg.com. Thank you for listening to the Market Moment podcast.